Hello, I'm Lelda Smits for the Finance News Network, and joining me from Pengana Australian Equities Fund is Senior Portfolio Manager Rhett Kessler. Rhett, welcome back to FNN.
Thank you, it's nice to be here.
Pengana Australian Equities Fund is focused on capital preservation and fair returns. Can you detail your strategy?
Right, so we aim, when we investigate companies, to have a sufficient margin of safety so that we can always preserve the capital, while at the same time generating a reasonable return for investors. Now, a reasonable return is 6% above the risk-free rate, so that they can be compensated for the additional risk of taking equities on board.
So, Rhett, can you outline which factors equate to an attractive stock for the fund, and which stocks do you actively avoid?
Yeah, sure. So that's the heart of our investment process. So what we like to do is look for three things. And I think most people look for those. Firstly, we like to buy good businesses run by competent management, and they must be at the right price. And the way we define a good business is it's got to be transparent, so we have to be able to understand it. It's got to be predictable, and the company itself has to have power over its stakeholders. Secondly, management needs to be competent in the areas required in that industry or specific company. And we have to make sure they don't stand between us and the cash flows of that business. And then thirdly, our after-tax cash earnings yield is our definition of the right price. So if we can buy something that yields us 6% now, after-tax cash earnings yield, not dividend, growing to 12% to 15% in 5 years, that's good for us.
Looking closer at some stocks, could you list some of your best performing positions and explain how they contributed to the fund over the past 6 months?
Sure. One of our best performing stocks was Woolworths, at a time when everybody was consumed by the fact that A, it wasn't performing as well as Coles, B, it had this loss-making startup called Masters. We focused on the main game, in that its food and liquor business was making really good returns for shareholders, and because of the aforementioned concerns, we could buy it at the right price. Great business, great management, right price, and pounce we did. And our investment thesis has been proved out, and the company's made a ton of money for us.
And how have you adjusted your portfolio following the reporting season just gone?
We're constantly adjusting the portfolio. Reporting season is a high volume time for new information. One of our really insightful views was that one of the market darlings that we held, Seek, came out with a spectacular result that not only confounded the bulls on the market on that stock, but effectively created real issues for some of the bears who were shorted. As a result, the company raced through our price target substantially, and we took advantage of, even though we love the company, we love the management, we couldn't hold it at that price. So we disposed of it at a very healthy profit.
And what is your largest position, and have you added to it recently?
So our largest position is Duet, a very boring utility company that yields us almost 9% with some nice growth. We like that. We like boring, particularly when it's very profitable boring. The company had a rights issue at a lower level when they did yet another great ancillary deal. We took up our full rights on that. The company's success was recognised, and so our position became too big, and we trimmed it slightly. And that's just the constant tweaking that happens in a real life portfolio.
Finally, Rhett, the benchmark index on the Australian share market gained 15% over last year. What is your forecast for this year, and how will it impact the Pengana Australian Equities Fund?
So we try not to get caught up in what the market's going to do. The market for us is a tailwind or a headwind. At the end of the day, we own real companies, and we have to live or die by the returns we get from those companies. It's exceptionally hard to pay school fees out of relative returns. I should know, I've got 4 kids at private school. So what we don't try to predict the market. We only buy companies that can preserve capital and generate that risk-free rate plus 6%. So we're always aiming for around 10%, and we think that's definitely achievable this year.
Rhett Kessler, thank you for your insights.
Thank you, nice to be here.